QuickBooks Pro Desktop 2021 Advanced Customer Payment. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view drop-down, selecting the open windows list. We're going to be recording a deposit, or basically an advanced payment. In our case, an advanced payment on a guitar that a customer is going to be purchasing that we don't have on hand at this point. Therefore, we're going to get the advanced payment in order to show commitment that the customer will be purchasing the guitar, purchase the guitar, and then provide the invoice. Now note, this is going to be something that can be quite confusing a lot of times if you're not used to basically an advanced payment, and the way we will be putting it into invoice into QuickBooks may be a deviation from what you might expect to see in normal basically financial accounting, but logistically it will work well within the QuickBooks system so that we can tie out our customer sub reports. So bear with us as we go through that practice problem. Now note, the same kind of concept can be brought into place anytime you have something. And if you work in financial accounting and you've been learning financial accounting, then this will typically fall under the category of unearned revenue. So when you think about unearned revenue, we're kind of thinking about that concept of unearned revenue. When you're thinking about different industries, certain industries will have this situation happening more often than other industries. In other words, let's think about the situation that's what's happening here. Notice our normal flow chart means that if we sold something on account, we would first create the invoice, then we would receive a payment on it in the future, then we would deposit that payment received. However, in this case, we're going to get paid, meaning this kind of component is basically happening before we did the work. In our case, before we provided the guitar. And then after that, at some point after that, we're going to record the invoice and then look for the rest of the payment at that point in time. So you got this kind of backwards system where the arrow's going from left to right, but we're have some component of it that's going from right to left. Now, some industries will always have something like this involved, and some industries will not have unearned revenue, and it won't be a problem. But if you're in something like real estate and you're renting something like apartments or something like that, then oftentimes you will collect a deposit or possibly the last month rent as well. And those are going to be types of things where you're getting money that isn't due to doing work from the customer, and therefore you're going to have to put it on the books not as revenue at that point in time that you receive it, but typically as a liability, because you have the money and you either have to earn it by providing the last month's rent or by basically dealing with a security deposit in that case, which you need the money in order to pay for the broken apartment that at the end of the time period. Or you might be in a situation where you will collect the money before all the time, meaning if you have like a concert that you are saving money for or collecting money for, the concert's going to happen in the future. You're going to be collecting money all the time over here before you did the work. So under an accrual basis method, you can't really record the revenue even though you're getting the cash for the concert until you actually have the concert, because that's when you earned the revenue. So in that type of situation, again, you'd basically, all the money that you'd be getting at the point in time you'd be getting it would be unearned revenue at that point. And then there's also like subscription type models, which are more and more relevant these days due to computer software applications often being on a subscription model, have a similar situation. The classic scenario is with like a newspaper or magazine subscription, in which case you buy a year's worth of newspaper or magazines, and that means that when we get the money, we're going to record it. It's basically a deposit because we haven't given them the goods yet. We haven't given them the magazine for a year, so we haven't earned it. So once again, we would record it as basically a liability when we get the money, and then we would record the revenue at the point in time that we earn the money. Applications are going to be very similar now. So application kind of software, if you even like a Microsoft Office package, Word and PowerPoint and whatnot, oftentimes you pay on an annual basis. So they might be recording the same thing, right? You're paying before you use the software, and then they should be realizing the revenue as you use it. Okay. And any kind of large purchase that we have a similar type of situation. So in our case, we have a guitar. The guitar is somewhat valuable, right? So if someone comes in and says, hey, I want this particular guitar, or we want this guitar in a different color or something like that, and we say, oh, we don't have that, we will go to our vendor and purchase that for you. However, we want a commitment, since this is a large purchase for us, that you're committed to the purchase, and therefore we would like a down payment at this point in time. And typically you'll collect 10 or 20% down payment to lock in the customer to the purchase. Then we'll go to the vendor, we'll make the purchase of the guitar. Once we receive it, then we'll actually create the invoice, and we'll tie out the credit that has already been made, or the deposit that's already been made. Will lower, of course, the amount of the bill for the invoice that we will provide to the customer. Now, as we create the sales receipt, so basically what we're going to do is we're going to create a sales receipt first, and then we're going to create the invoice. Now, this is a little bit backwards than what you might think, because what does a sales receipt do? The sales receipt, as we talked about, is going to be increasing the undeposited funds that we're then going to go into cash. It's basically increasing cash. And the other side typically will decrease accounts receivable. But notice we don't have a receivable on the books because we didn't enter the create invoice in the first place. So how can we decrease the receivable? And that's a little bit different than what should happen. So let's open up the financial statements to take a look at it. If I go to the reports drop-down, company and financial, and we take a look at the balance sheet, let's say the balance sheet standard, changing the dates by going to the customized reports up top from 01/01/21 to 12/31/21. And then I'm going to say OK. So notice what would happen. I already have something in the receivables. If I put a negative receivable, it would be basically going down. But normally we only decrease a receivable if we're decreasing money that has already been increased, like someone who owed us money now paid us. So we shouldn't be decreasing a receivable in terms of normal financial accounting. What should we do instead? We should be creating a liability called something like unearned revenue or customer deposit or something like that, representing the fact that we got money. So cash would be going up or undeposited funds going up. The other side is a liability, representing the fact that either we owe them the guitar, in which case we'll collect the rest of the money and record the revenue at that point in time, or we should give them the money back. So the money that we have represents a liability until we finish the work, whatever that work is. That's what we would record in normal financial accounting. However, if we record a liability account down here called unearned revenue, notice we don't have a nice link between that liability account and the subsidiary account, meaning this account's receivable. If I go to the subsidiary account by going to the reports drop down, go into the customers and receivables and take a look at the customer balance detail report, notice we have this subsidiary ledger tying out the payments. I want to be able to see a subsidiary ledger that shows the invoices and shows the payments related to it. If I put an amount that was given to us by a customer that's related to an invoice that we're going to make in the future into some other account other than accounts receivable, then QuickBooks doesn't have this nice link to be able to tie out the invoice that we're going to create later to the customer that we have deposit that we got earlier. So how do we deal with that logistically and still record it properly with regards to our financial statements? What we're going to do here, and so this is the thing, we're going to deviate from financial accounting, but it's the same kind of concept that you would do with other kind of adjusting entry kind of transactions to make the logistics easier in the books, and then do an adjusting entry at the end of the month. However, the adjusting entry will not be the same type of adjusting entry for unearned revenue as you have seen in your accounting classes if you do financial accounting. What we're going to do is we're going to create the sales receipt, which will make a negative receivable, meaning we're going to make one for Anderson Guitars is the one that's going to give us a down payment. That'll result in a negative receivable, meaning like it would be like we owe Anderson money, which we do, but you don't really record that as a negative receivable. You usually record it as a liability. We're going to record a negative receivable here so that when we then create the invoice in the future, then it'll tie out to that negative receivable. So everything will still be in balance if I go back to the balance sheet. However, this number right here on the receivables, if I was to look at it from a financial accrual standpoint, would actually be too low at that point in time because we have this negative receivable. What should really be happening is we should have a positive liability down here. So does that cause us a problem? Instead of increasing the liability in our accounting equation, we made a negative receivable, so logistically we can tie it out in that sub-account for our customers. Does that cause us a problem? Well, not really. I mean, unless that amount is outstanding at the point in time that we make the financial statements. In other words, when we make the financial statements at the end of the period, which is the end of the month or the end of the year, we will have this receivables if it's still outstanding. If we haven't completed the process, then the receivables would be understated and the liabilities would be understated. So when we make our financial statements, we can just do an adjusting entry for that, meaning at the end of the month, just like our any other kind of adjusting entry, we could say, oh, okay, now we have to adjust for the receivables being too low by increasing the receivables for those amounts that are negative receivables, and then creating an account down here called undeposited funds or customer deposits or something like that. So, and then we would reverse it right after we make the financial statement. So we would just do an adjusting entry for it. That way we can work it logistically so it works well within QuickBooks. The subsidiary ledger works perfectly for us that way. And we can make our financial statements correct as we normally do on a periodic type of basis at the end of the month or the year. Just realize that's different than the normal kind of process you'll see for undeposited funds in financial accounting. In financial accounting, you're typically thinking about a company that receives their money before they do the work, like a subscription model basis, and therefore all the revenue would be recorded in undeposited funds throughout the month. And then at the end of the month, you're going to decide how much of those deposits have been done, how much of the subscription model, for example, you have completed, how many magazines you've delivered, and then you'll lower the undeposited funds and record the revenue, and that'll be your adjusting entry at the end of the time period. This is a little bit different because we have a little bit different of a problem. We have this one deposit. We don't always have a subscription model. We have this one deposit that we got before we actually have the invoice. So we're going to record it as a negative receivable. And then at the adjusting entry at the end of the month, we'll just reverse it out for temporary purposes to make our financial statements right as of that point in time. Okay, let's do it, and then we'll check it out. So we're going to go back to the home page. We're going to say, all right, this one customer, Anderson Guitars, came in and said, I want this one guitar that I don't have on hand. I'd like you to order it. So we said, we're going to order it, but we need this down payment. So we're going to record the received payment before we get the invoice. Let's record the received payment. And this is going to be for Anderson, is a customer we've had in the past. I'll just type in Anderson Guitars, and I'll just say that it's cash that we're getting. So they're going to give us $250 down payment on this guitar. We'll say it happens on the 16th. No reference number, and undeposited funds is going to be the increased account. And notice down here, we don't have anything to check off. Normally, we have an invoice to check off here, or otherwise we wouldn't use this form, because the customer payment form means that we're decreasing accounts receivable, and we only decrease accounts receivable if Anderson owed us money, because that's what accounts receivable typically means. So when I record this, what's going to happen? Well, it's still going to decrease the accounts receivable, and we're going to record money into undeposited funds, but it's not going to be able to tie it to any invoice. It's going to record a negative number in the subledger for Anderson Guitars, our customer. And that's what we want so that we can tie it out later. So I'm going to say, all right, let's check it out, save and close. Save and close. It says, hey, a credit for the overpayment will remain in the customer account, meaning you got this overpayment from this customer that we can't tie out to any receivable. We're just going to keep it there till we can. And so we're going to say click credit memo to save the transaction and print a credit memo. So we could print it out if we want to do that, print out the credit memo here, which might be good for the customer. Click OK to save the transaction. Click cancel to go back. So I'm going to say OK. Let's do that. And then what happens if I go back to the balance sheet then? Now, double clicking on the receivables, it's still a positive number in total, but I have this negative 250 down here bringing down the total receivables. If I double click on it, then of course we get to our customer payment. Closing this back out, then we're going to go to our customer balance detail over here. And notice in Anderson Guitars, we have this negative 250, which again is wrong, because that kind of means, what does it mean, like a customer receivable, and this one's a negative number? What does that mean? That means that we owe them money. We do, because they gave us a deposit. But then it shouldn't be an asset, it should be a liability. Well, it should be undeposited funds. Why did you record it here in the asset side of things? Because we want this subledger to be able to tie out to the invoice, which happens later, which in QuickBooks is done with the accounts receivable account. Okay, so that means that basically this number down here, the total, which is on the balance sheet, is really understated. It's understated by that 250, and we should have a liability on the books for 250. Is that a problem? Not really. It's not really a problem. One, it's pretty small, but it's not a problem either, because once we get the guitar and sell it, then this will cancel itself out, because we'll create an invoice that will tie it out, and then everything will be fine at that point in time. But what if we get to the end of the month and we still have this outstanding and we haven't had the invoice and we need to make the financial statements on an accrual basis? Well, then we'll just do an adjusting entry. The adjusting entry will increase the accounts receivable and increase the liability, and then we'll simply reverse it right after the financial statement date, so that we can get back into this system, which will logistically work, even though technically it's not quite right in terms of the net between the receivables and the liabilities. Okay, so I tried to explain this basically in depth because this is an area where I get, people will question it all the time because it's a little bit different than what you will see in financial accounting, but hopefully you can see why logistically, people do this. You'll see this in practice. It'll confuse people, but if this happens, you can see how it works, how it ties together, and you can do an adjusting entry in the same kind of alignment with the reasons why you do other adjusting entries to logistically make the bookkeeping easy, and then fix the financial statements periodically at the end of the month or a year so that you can provide those financial statements in the format of a more accrual basis format. So this is where we stand at this point in time. We've got the balance sheet, so you can check that out if you're checking your numbers and working along with us. I'm going to open the trial balance as well, hitting the drop down, go on down to the accounting and taxes and trial balance, changing the dates up top from 01/01/21 to 12/31/21, January through December 2021. Here's where we are on the trial balance.